today, so let's talk to the man brokering the deal, Abe Garver from Focus Investment Bankers, to talk about the market and the investments that he's been working on. This is a bonus episode of The Business of Tech. Abe, I've been super excited to have you on. For those that may not be familiar with you and your firm, give us a little bit of a sense of who you are and what you've been doing.
Thanks, Dave. I am so unbelievably passionate about MSP M&A. I even have license plates on my car that say MSP M&A. We have my firm, Focus Investment Bank. It's an ESOP, been in business about 40 years. We got involved in the MSP vertical with a private equity group making a platform, what's known as a platform investment into one of our clients back in 2018 for the first one. And then in 2020, we helped 4 MSPs get private equity platform investments. Fast forward to today, we just announced our 9th PE-backed MSP platform investment.
I'm going to ask a really basic question because this may get confused for a lot of MSPs. Help me understand the definition of what a private equity investor is and what their goals are.
So private equity investors today that are investing in MSPs, historically the typical one was a lower middle market private equity fund that had raised $500 million. And you kind of, a rule of thumb, if they raise 500 million, they're going to make 10 what are called platform investments. So about 50 million of equity into 10 different verticals. And more often today, there are now 100 PE groups that have invested into MSPs as one of their platform portfolios. More and more today, private equity groups, not just the 500 million ones, but I have $1 and $2 billion private equity, $1 and $2 billion funds that are trying to deploy, dividing by 10 again, more and more money. In the case of a $1 billion one, 100 million in equity. In the case of a 2 billion, 200 million in equity. So there's just this, that really sets the stage. Like there's more and more money coming into MSP investments, and a lot of it is just because the funds that have gotten kind of picked this up and gotten interested are larger and larger.
Okay, but at a really basic level, this is a group of investors that are trying to pool money together to own shares of company, own investments in companies, and trying to spread the love around a little bit to have a few of these do well, right? It's really kind of that basic. Okay.
And kind of two things. There's private equity, which is really, we think of institutional money like retirement systems, kind of states, and then also family offices. I have also had a buyer that's a family office with one of the Hunt family members that is kind of a hybrid between a private equity and family office.
Let's separate that out from VC, venture capitalists, right?
Mm-hmm.
That's more raising funds from a different style. Help me understand the difference for those that may not know.
Yeah, great question. So venture capitalists, nothing against them. They tend to invest in companies that don't currently have cash flow. And MSPs are really unique and can kind of, on the, kind of tier, you might start with friends and family, and then venture capitalists is the next step up, private equity a step above that. And private equity really likes these investments that have dependable cash flows. And so it kind of one step up. And then even another step higher would be a public, doing initial public offering and having the shares traded publicly. So VCs tend to not be great investors for MSPs because they're looking for, 50 time plus return. And they're looking for things that are just kind of a moonshot and not, unlike MSPs, which many of them are dependable, great profit generating kind of revenue sources, income sources.
So you published an article recently that I was really intrigued by, and it's about talking about that MSP valuations may withstand inflation. But one of the things that jumped out at me is there's a quote in there about, an investor looking could write a check for $1 billion. Give us a little bit of a scope of the size of deals looking for, because for if a typical MSP is 1.4, 1.6, 1.7 million in revenue, they're hearing writing checks for $1 billion and may not initially link that to them. What are kind of the sizes of deals these investors are looking for?
I'd say 95% of the deals are in the, call it 5 to 15 million range, add-on investments. And then the platform investments are kind of in the 25 million to, when they're getting the first private equity money, 100. And then something called the recapitalization, once the private equity group's getting its second private equity investor, a larger investor. And examples are Antiva, Cortelligent, and Thrive all had their recapitalizations. Those end up being at about $250 million, call it 250 million size. And then in that article that you're referring to, kind of out of the blue, I got a notice from, got contacted by one of the largest private equity groups in the world saying, hey, we want to make an MSP platform investment. My fund is 10 billion. I'm managing 10 billion. I'm making 10 platform investments, and I can write a check up to 1 billion. And at first I didn't have an asset to, really kind of serve up. The very next day, I was talking to a private equity group who had backed an early platform, and they had grown to 150 million of EBITDA, which is incredible. And so I immediately put the dots together, and that conversation, the introduction between the buyer and the seller, hasn't happened yet, but there's some kind of legal paperwork in process to help get there.
Gotcha. So there are deals going on of all different sizes here.
Yeah.
Let's play the valuation game here for a little bit before we talk the broader
Absolutely.
market, because I know listeners and MSPs are always dying to get a sense of like, well, what is my provider worth?
Mm-hmm.
And so to do this, I'm actually gonna sort of say, like, all right, let's play with an example MSP.
Perfect.
And then you can kind of walk through it. And if I use my typical MSP model on this, let's say they're doing, about 16 staff, they're 1.4 to 1.7 million dollars in revenue, of which, say 160K per month of that is a monthly recurring component. And so they're going to drop about 51% to the middle, right? So they're that's the after their cost of goods sold, and they're dropping, probably 12% to the bottom. That feels very average for this space. Like, how would you be walking through to value that organization?
I would actually like an easy example to think through. It would be a 5 million revenue, just because it'll make our numbers, the math, really easy. A 5 million revenue, best in class kind of EBITDA margin of 20%. So that 5 million of revenue would be throwing off $1 million of earnings, or what people call EBITTA, this earnings before interest, taxes, depreciation, and amortization. It's basically kind of free cash flow that comes out. So in that example, the 5 million, we've run a process for a business this size pretty recently. 5 million revenue, earning a little less than $1 million. Had all sorts of, probably 50 different buyers looking at it, maybe 30, 35 signed NDAs, and then a call for offers for it. And we got as high as let's call it 7.9 times that earnings of $1 million, or call it basically essentially $8 million. That's a really, it's really difficult kind of, I would say that's the top end of the range from a valuation perspective. And you can't just walk out and get like a 7.9 or an 8x multiple. There's a very competitive process, and one of the buyers has some sort of synergies that don't exist with all the other kind of financial buyers, and they're able to, as a result, in a competitive situation, they're able to pay more. But I would say that, on average, $1 million of EBITDA, depending upon a number of factors, would trade between
Okay.
6x and 7x, somewhere.
And the variable here is going to be how much they're dropping to the bottom. Right? Most of these deals you're looking at are measuring both on the bottom line and the EBITDA number.
It is. It's the EBITDA, and then it's the quality of that EBITDA. And by quality, I mean how much of that is recurring revenue versus if there was a huge product sales during that year that were dropping down, the recurring revenue's worth more. And then also the growth of really three things: percent recurring, the growth in the percent recurring in kind of overall business, and then three, the retention. So that, to the extent that business, 90% of that revenue will still be there the next year is super important. It's one thing if you grow like crazy and you lose the customers, but if you can, grow nicely and retain them from a valuation perspective, so we're looking at the quality of the EBITDA in addition to just
now a subtlety I don't want to
number.
lose in the differences of examples is, of course, I throw out an average, which is that's a smaller org than the straight number. Help me understand, is there kind of a lower bound of the point where, like, okay, the deals just don't make any sense when it gets down to a particular low end that you got to cross this threshold to even be having this conversation?
All the great questions to ask. So 500,000 K of EBITDA or kind of earnings. So like in our example, if instead of 20%, we had 10% on that 5 million, 500K is really where all of these institutional investors that are making add-on acquisitions, it's really where they start. And so there's, as a result, the pool, kind of the pool of buyers increases, and the big pickup is when you get to 500K of EBITDA. So if somebody's at 250 or 300K of earnings, if they can, just kind of grow into that 500K, their valuation will be greater because I can bring more buyers that have institutional money backing them to bid.
Okay. Now, you said something in there I want to make sure that we're all tracking on too. You talked about an add-on buy. Walk us through the kind of different kinds of buys that are going on here in the market for these platform players.
Right. So to become a platform, I'd say loosely one of the requirements is that somebody's gotten to 2.5 million of EBITDA. So it's over 10 of revenue, 2.5 of EBITDA. That 2.5 EBITDA business gets a private equity group to back it, and then it will go and look for, and let's say it gets the private equity group to back it, and the private equity group pays 10x. It will then go look for companies that it can acquire that are smaller, like the 500K, the million K, to quote unquote buy their multiple down. So instead of the overall average cost for the private equity group being 10x, if it can go buy another 2.5 million at, let's say, 6x, now its average cost is 8 for all 5 million of EBITDA that it's acquired.
All right, I'm going to switch to markets a little bit right now because I think it'll be fun to read the tea leaves a little bit and get your sense of it. So we're talking right now, summer 2022. The name of the game right now we're all playing is, are we going into a recession? What's the market going to look like? Give me your sense. Are you optimistic? Are you pessimistic? And through the lens of, we're talking to the owner-operators of these MSPs and IT services companies. Are you optimistic?
I'm very optimistic on it is it's not really my area of expertise where the economy's going. I would say through COVID and also now with interest rates rising, in MSP world, we can do nothing wrong. Like it's kind of like we had COVID, everything shut down. Go figure, MSPs took off. Interest rates are rising in 0.75% increments. Go figure, people are doubling down on MSP investments. And part of it, as I've kind of heard from the sharpest minds, the private equity investors, and there's some quotes in recent articles, they point out, unlike some of the tech companies that have revenue, that are valued based on revenue, these MSPs have, kind of at the core, we've got EBITDA that's very, 10, 15, 20% EBITDA, very predictable. It's recurring. It's not a crap shot in the future like a SaaS company that needs to keep growing really quickly that's not making any money. And so when interest rates are going up, those risky cash flows way out in the future of a lot of the tech companies in the NASDAQ get discounted quickly. But for MSPs, our cash flows are predictable. And what the lenders said to me, both Patrick at AB Private Credit and Reed at Deerpath, what the lenders said to me was, Abe, our loans are only about, in spite of all the Fed's done, our loans are only about 1% more expensive because they're tied to LIBOR. And we had a 1% floor. It was the lower of, or the higher of 1% or LIBOR. LIBOR was down at 0.25%. And so LIBOR is now almost up at 2%, but those loans had the one floor in them. So there's a one-on-one relationship. But basically, both lenders, and these are the top lenders, they've done many of the platforms, the first initial platforms we've been involved with, and then they've done the recapitalizations of the larger ones of Antiva, Cortelligent, Thrive, and they're leaning in. So as it relates to MSPs, like I think we're all in relatively good shape. It is a function, some really bright, I think of Joe from Frontneck, who's an investor in an MSP. He pointed out, Abe, I think, and it was kind of a point we were going back and forth on. My first point to him was, Joe, I've got somebody with $1 billion trying to buy MSPs, and there are no MSPs at that size. Supply and demand tells me it's going to go up. And he said, I concede that point, but on a MSP by MSP basis, looking at your underlying verticals that these that the MSP's in, and the health of those verticals. So, for example, when COVID was going on, the dental vertical MSPs really had a really, really, really hard time. Because no one was going into their dentist, and now they're rebounding and bouncing back. So what we think it will happen is that the consumer facing, we haven't really seen it with hospitality yet, but hospitality vertical focused MSPs were hurt in COVID. Most of the MSPs today are what I call vertical agnostic. They're in every vertical, and I'd say most of those are pretty well diversified from if one of the sectors of the economy is hurt, especially the consumer facing, that's, it's not going to, completely take down the business.
Okay, so I'm going to ask something that one of my supporters on Patreon has asked, and I think it's a great question to offer to you as well for your insight. They specifically said, like, how would someone in finance, like somebody like you, recommend that they do recession planning with their customers? What are the things to be looking for in order to work with them and do planning for the period we're about to come into?
Gosh. That's a great question. It's a great question, and I think just that they're wanting to have those conversations. I don't have any specific kind of suggestions of things they could do to kind of make themselves more in a defensible posture, but I think that's a brilliant way to say to your customer, I care about you and what you're about, and I want to be helpful in protecting you, from any impact of the recession.
So you brought it to my attention as the guy who's been watching the news on this, that the 100th private equity backed platform deal was just announced. Give everybody a little bit of a sense of what does this mean? Like it sounds like a great milestone, but what is it?
Yeah,
What does it mean?
it's to me, it's a coming of age for MSPs. It is, the initial kind of private equity investments, the first ones were back in 2014, 2015. It's a maturing of our, when we think about like innings that we're in, it's a maturing of our overall industry, that they're private equity groups. They're now, we can count 100. It's a phenomenal milestone. Focus. Let's see. We have announced 9. We have 1 in signed letter of intent. I got bids yesterday and the day before for an 11th, and there are 100 that have happened kind of in the world. Maybe 80, 85, 90 of those are U.S. based. So I think the same thing will happen in Europe. I think we're 2-3 years ahead of Europe from private equity helping kind of consolidate. But overall, it's really strengthened these businesses that these MSP businesses. I can think of a platform, one of the first ones we did in 2020 started with 10 million of revenue, 2.5 of EBITDA. 10 months later, because of private equity, it's at 16 million of EBITDA and 100 million of revenue. And it's a stronger, better business because it has brought a lot of peer group companies together. It's more diversified. There's more job opportunity for the employees at that collective organization than there was before.
So you're in a really unique position to talk to these different private equity groups as they kind of come in and start considering what's going on. What is your guidance to these owners to understand what they should understand about working with private equity? In particular, I'm thinking about this because the number one thing we always talk about in any kind of merger and acquisition deal is always culture,
Yeah.
right? You got to have a culture match. How do they know? How do they make the connection? What questions should they be asking? Help these MSPs understand a little bit about what they need to know to be smarter about these conversations.
It's such a timely question that you just asked, because in this 100th PE-backed platform investment, PE Hub was interviewing me and the founder CEO and the private equity group, and they did the interview, and then I got this email back from PE Hub, and it said, you mentioned that the culture was a great fit. I can't really print this unless you tell me what you mean. And the CEO said back, we both like to mountain bike. Like me and the founder CEO and the private equity group that's based in Park City, they're both passionate about the same thing. So they that was it's an example of kind of cultural fit between the investor and the founder CEO, not necessarily the culture of the business and the culture of the private equity group, but just kind of on the human level, how they connect. And that's I love that about when we run a sell side process and find if there are 30, 35 signed NDAs and we get 8 or 10 bids, and then you're meeting 5 of them. There is my goal, and I've seen this over and over, is to find, I want to work on transactions in which management teams are passionate about joining together with the private equity group. And inevitably it happens over and over. When you have this large, broad auction process, there is somebody that they want to pick that's really number one to them, and there's not a close second. And it's real obvious. It starts to become obvious in the initial phone calls when the offers are put forward. People care about 4 things. Generally, it's the financial fit, the strategic fit, the cultural fit, and the geographic fit. And they're really scoring all their options based on those four. And I love it when somebody's got that number one pick and there's not a close second. That's how I decide if I've done my job well. If they're mediocre about everybody, I don't care if the deal gets done. I didn't really do my job well. I really want to find them where they're passionate about joining together.
So I'm gonna ask one sort of wrap up question here to try and understand, because it's the one takeaway that I think is important is that they're very different organizations. Different equity firms work in different ways. Let's make this a little dramatic for intentional reason, right? So help us understand the differences between the kind of PE firms that you're talking about versus the same name kind of private equity firms that are behind the software tool vendors, right? There's private equity behind what's going on with Kaseya or what's going on with Enable, or like they're using the same words, but actually I think what I'm hearing is they are actually very different organizations. Help paint a little bit of a picture of what the differences in the kinds of private equity firms
I love that. And two stand out to me, like it is a very different investor. And like many things, like having a niche and really dominating the niche, I think is a great business model. And two private equity firms stand out to me out of the thousands of them as great software investors. It's Thoma Bravo that has the investment in ConnectWise, and then also Insight Venture Partners that has so many software investments. And both of those have really grown into, I think Insight might have just raised a $20 billion fund. They're really sharply focused in software. And MSPs, we have a business services focus, so it attracts a different, many times it can attract a generalist investor who wants exposure to 10 different kind of platform areas or parts of the economy. Thoma Bravo, although they're dominant with MSP software, they don't own any MSPs. Insight Venture Partner, they're dominant with software, but they don't own any MSPs. And I really like Insight Venture Partners. I've grown up in this business, admiring a couple people and knowing them personally. Would love to, sell a MSP platform to them. It's just not going to happen because they want 100% recurring revenue, super high growth, as opposed to many of our MSPs, the median might be 60% recurring revenue. And overall, our industry is growing kind of 8% for MSPs and 16% for MSSPs. So just a different kind of categories of investors with different interests.
That's the key point, is that we're using the same words, but they are actually have different motivations, different kind of investment. So I'm going to wrap up here with one sort of fun question for you, Abe. So we've got an audience of MSPs out there of all different sizes. If you could tell them one thing that you wish they knew about this space, what's that?
Thanks for that softball. I would say IT Nation, Evolve peer groups. They're now 700 MSPs that are part of it. I go to the quarterly peer group meetings, and these peer groups, the of all the platforms I've been involved with, they keep coming they keep coming out of these peer groups. Their organic M&A kind of pipeline that they have, I focused in e-commerce M&A prior to MSPs and wrote a column for Forbes about it, kind of, et cetera, did lots of transactions. What is very different about MSPs, unlike e-commerce, everybody is, it's like a race to the bottom, gross margins deteriorating. With MSPs, historically, there hasn't been geographic competition. So these peer groups have been put together and established where you've got people sharing best practices and how they're doing really well in different markets with each other on a quarterly basis, holding each other accountable. And they've just really, it's kind of like everybody has risen up together as a result of it. And so I would just say, no matter where you are in the stage, just starting out to established MSP, all the way now they have something called it's like once you've sold your MSP, they have a peer group for people. It's called S to S, Success to Significance. And Arlen Sorlinson is the kind of head of the IT Nation Evolve that's sold to and is part of ConnectWise. And so that I would just really encourage everybody to, try that out at some point in time. It's the greatest thing you can do to help your valuation, your culture, kind of so many things.
Yep. And I'll reveal my own bias. I'm an alum of when they were called HTG back in the day. Abe, I appreciate you coming on to talk with me today. If people are interested in getting in touch with you, what's the best way to do that?
Yeah, just email abe.garver@focusbankers.com, or just Google my name or look on LinkedIn, and would love to connect with you.
Awesome. Thanks for joining me today.
Yeah, it was awesome.
Thanks for your time and attention. Time is a finite resource, and I really value you giving me some of yours. If you like this video, you can let me know with a like of the video, and even more valuable, hitting the subscription button. My content is all free, and I use metrics like subscriptions to pay the bills, so it has real value. The content here is produced under ethics guidelines posted at businessof.tech. If you're interested in more content like this, you can get access to content early via our Patreon at patreon.com/MSPradio. It's our give what you want model, where you set the value of what you think the content is worth. If you like this podcast, you can catch it daily as the 5-minute news and commentary show, The Business of Tech, available on all your favorite podcatchers with links at businessof.tech. Just hit that big blue button to subscribe. Again, thank you for taking time out of your day to listen, and I really value the interaction. If you want to say something in the comments, I do respond and watch all that, and I look forward to talking to you next time.